Good afternoon, everyone. Thank you for joining our May webinar on preparing your business for sale. I'm with Barry Hopkins, and we are going to give you all the information you'll need to know about this subject. But before we do, I would like to just get a bit of information about our audience, and as we usually do in these monthly webinars, is to ask firstly the industry that you are from, and if you could please complete one of the options there so that we can tailor the content today to the audience's needs. Okay, we're starting to get some responses in. We'll leave that poll open for another 20 seconds or so to get some answers to as to what industry you are from. Okay, so we have a good smattering of people from the legal industry and real estate industry, 40% other. We'll try and work out intuitively what those others are. Okay, the next poll I would like to, the next question I'd like to ask is the size of your business. Can you please let us know what category your business falls into in terms of number of employees? Okay, all right. Starting to get some information coming in there. If you can, please just select one of the options. Okay, we'll leave that open for another few seconds. There we go. All right. So that's the we've got a reasonable distribution there among the sizes of businesses. Okay, that's good to see. Now, the next question I'd like to ask, just to give us an idea about the audience so we can tailor what we say today and what information we provide, is what your role is in the business. Okay, so we've got the options there: owner, administration, sales, other. Okay, so it's good to see those responses. Again, all right, well, just a few more seconds. Thank you for your input. And we have a good representation of business owners, which is good to see. 43% other. We'll try and work out as we go through what those, what your roles are. Okay, so most of you would have this man in focus this morning, particularly in the small businesses under $2 million. Big benefits for those businesses. But as we go through, let's see what is your focus after Barry and my address. Just a couple of more questions. This, are you considering a sale or merger of your business in the next little while? This gives us some information about whether or not you're in the process of selling, and what sort of information we need to provide you this afternoon. Naturally, the budget moves will have some implication to your intentions. Okay, all right, so a few more seconds, we'll close that poll off. There we go. All right, so we've got a good proportion of attendees that are actually thinking about retiring, or at least selling their business or a merger one way or another. Finally, before we get started, just want to get a feel of what issues you see as important in the process of selling your business. What are the most important things for you, or what are your anxieties about considering selling your business, putting it on the market, or attracting a merger partner? Just leave that poll open for a little bit longer. Okay. So equally divided, getting the business into shape for sale and tax treatment for the sale price. Okay, now Barry Hopkins is an advisor with Exit Alliance, which is a national advisory network for business owners who are seeking to retire in the coming years. It has a wide variety of services among its offerings, including business valuation, restructuring, tax advice, risk advisory, and cut off at the bottom there is sales. So Exit Alliance brings together professionals from various different disciplines to make your sale proposition better value to prospects. And without further ado, I will now hand over to Barry for his delivery of the first part of today's session.
Okay, thanks Peter, and welcome everybody. Look, really what I'm talking about is how you'll access the value you've created in your business, and so that's my focus. So why? Look, this is a quick little YouTube video that you can watch in your own time. Probably the saddest part of a child's movie to ever begin a movie that's been successful, but really gives you an idea about why you need to be thinking about your retirement and the process to get there, that you end up with the best value. Again, like with most professional presentations, as a disclaimer, this is general information. The specific information relevant to your own cases that I don't have any access to at the moment. So you really need to take that into account. Have a read of that. It's quite relevant. So what's succession? And it really steps in 4 elements, in my view, for a sale of a business. And they all relate to really that bottom, that succession is about wealth and creating wealth and protecting that wealth. So the first one is about, the basic succession thing is about training staff up to take on higher and different roles. And that allows if someone goes on holidays, there's someone there to step in, or alternatively if someone leaves, someone's there to at least cover that role while you're employing a new employee. But then succession then takes the next step, and it begins more around you as the owner, and that's looking at repositioning your business and your role as the owner as the business grows. When you first start out, you're doing everything, but once your business is established and you're employing 6 or 30 staff, you need to be able to reposition those roles that people who are coming on board, or otherwise, the volume of work that comes to you is just way too much. And it also extends to where you're going to a step change in the size of your business, that you really need to bring on specific expertise to allow you to do that. And so you've got to have some sort of succession of passing on the roles and responsibilities of different people. But what we're talking about today is really about succession, and that's a transfer of ownership either to family, management or staff, or an outright sale of your business, and even perhaps listing your business where your ownership stake is converted into wealth. But the other bit that most people don't think about is succession planning as an insurance policy. And really, it is a very cheap insurance policy, because every business owner and every business faces the 4 Ds, as I call them: disease, death, divorce, and disagreement. So when those things happen, if you've got no plan or succession planning in place particularly, these critical events basically in a lot of cases destroy businesses and the wealth that's been created. And it doesn't matter whether it is a small or a medium business, without some process in place, it is critical. We dealt with and talked quite regularly with an accounting firm, and they had a structure in place, and they had some buy-sell agreements with some insurance. And in 2 years, 2 of the partners, one was diagnosed with cancer and the other one had a heart attack. And because they had a plan and structure in place, they were able to pay both of those partners out, and the 2 remaining partners weren't required to remortgage their houses or do anything drastic like that to retain the business. And because they'd had a succession plan and a structure of what they were going to do and how they worked that process, it was a relatively seamless process. Both of the partners that had the cancer and the heart attack are still alive and doing well, but they've got wealth now that they can continue their lives and do what they want to do post-work. And the business has maintained over 95% of its client fees. The new partners are looking at bringing on another partner to manage the workload, and it looks good. But the cost of doing that was relatively cheap, as opposed to the whole business probably collapsing with such such drastic impacts in such a short period of time. So let's have a look at some facts about selling businesses and with small business and where they're sitting. So only 30% of businesses make it to the second generation, and of those, only 13% get to the third generation. And I'm sure most of you have heard the saying, rags to riches to rags within 3 generations. And that saying's been around for years and years, and way before I ever heard it. And you see those things happening quite often. And then we look at the age group of business owners, and 66% of business owners are over 50, and the numbers that are over 60 are increasing rapidly. And what that's doing is, last week I travelled around Australia doing some presentations to business brokers on accounting, and one of the things that the business brokers said to me across the board was, they're finding enough businesses to sell. Their real concern is finding enough appropriate buyers to buy the businesses that they're selling. So, there's more business coming on the market, but less buyers, and less buyers with the access to the amount of funds to buy particularly the good businesses. We then look at 75% of owners are transferring their business to the next generation, which is quite interesting when you compare it to the first two stats, or particularly the first stat. There about only 30% go to the next generation. So there's something unusual happening there, but that relationship's been around for years, and it really gives you an indication that if you're planning to transfer to the next generation, you've got some issues that have to be addressed and dealt with. The next figure is really scary, and for business owners, because 83% of business owners don't have a succession plan. And what's more scary about that is that figure's not much different to the figure I saw when I started as an accountant in the mid-80s. And that's been thrown around for a long time, and it is a critical point. The biggest issue for a small and medium business is the inability to sell your business, and that really puts you in one of two positions: is liquidate the business and sell the assets, or keep working indefinitely. I talked to a business owner, and they were both 84 and still working, and they'd wanted to get out of the business for years, but they just couldn't get enough money for the business to retire, and so they've just sort of stuck in there and are still working. Now health's taken over, and they basically just closed the business down. So the risk of not having some structure and plan in place is you just keep working. And looking at the family side of things at this last point is there's no real structure in there to get an agreement or a formal arrangement to get some decision making going within the family, which makes it very hard to have a discussion. It also becomes particularly difficult when family members are working in the business to ensure that they have the best skills to take the business forward. And if you're wanting a legacy of handing over your business and your kids don't have the skills to take it forward, there's a real problem there, and it may be better for those children to actually sell the business and provide them that money in an income stream going forward than letting them go into a business that they're going to have trouble running. So some of the two take-home messages really that I'm trying to get through to you is that succession and transition or sale is not business as usual. You're really looking at what buyers want and a focus of you leaving, which takes a difference in the outcome of what you're doing, and that's quite different mentality that's required. And then looking at succession planning, some dollars in means probably in a lot of cases significantly greater dollars out. And so, there's not many investment opportunities that have the return of really committing some time and value into this space. Because without planning and a real commitment by you, your business is not likely to deliver the value you expect. The other thing that I received from the comment I received from the business brokers was that, on the whole, most businesses value the business at a greater value than what would be reasonable in a current market. So, they've either pitched it at what they need to go, or they're looking at some valuation that may have been given to them 5 or 6 years ago before the GFC. To get things started for most people, and this is planning 101 in most cases, is really where are you now, where do you want to go, and what do you do when you get there is probably an important question as well that fits into that space. And then how do you get there and move to where you want to go, from where you are to where you want to go, and what options do you have to do that, and what risks and opportunities do they present from different options. Because as with most things, there's lots of different ways you can take this, and you need to gather information and spend some time to make those decisions. But once you've decided where you're going, you need a plan, and most importantly, you need to be able to implement that plan to achieve the options that you've chosen. And for many small businesses, you're already time poor, you're busy, you've got critical things happening about, the client whose goods haven't arrived, or a staff member's sick, or just got a new job, your wife or kids are sick, something else is happening. So really that implementation and the problem for many business owners is succession continually gets put in the back burner, and time flies very quickly, and the real value of your business is when you exit. So what next? Well, have a little think about if someone came with a checkbook, and what would you want or probably need to sell your business? And that gives you a figure to have a look about where it's at. And, that's an important feeling to understand what you really want. But you then need to test that against what the market's actually paying for businesses like yours, whether anyone else actually wants your business. Is it saleable? And the economic and business situations that are currently happening. If there's less buyers and more sellers, the buyers are going to be very selective. And if you don't hit the target that the buyers are looking for, and other businesses do, well, you'll probably be the second off the rank in the sale. So that's something you want to begin thinking about, and finding out whether there are people that or specific people that may be interested in your business. There may be a competitor that wants to buy you out so they don't have to compete with you. There may be some large overseas business that wants to get a foothold into Australia, and you're a business of a size, with the larger businesses that we're talking to today, may be attracted to one of these businesses to come in, and they will pay a premium to take your business out. Important to recognise at those points, you have a very small window of opportunity there, and you need to be ready to take advantage of it. The next slide is really what will you do when you exit. Now when I put this slide in, I tossed up whether to cut it out, but it is a critical slide, because talking to a number of lawyers and some business brokers, and a straw poll in Perth on Friday, every business broker had more than one business that had been selling where the owners had balked on the last few days and pulled out of the sale. Simply because, and in most cases it was simply because the sellers, the business owner, just didn't know what they were doing, and they were just scared on their next step in life, and they had done no thought about that. I was approached and did some work with a lawyer here in Brisbane, and at the beginning of last year she lost 3 contracts because of similar issues, where the business owners had pulled out because they didn't think they were getting enough money, and others where the owner just didn't know what they were going to do and thought it was better to have something to do. The damaging impact of this is that in a lot of cases, pulling out of a sale like that is incredibly bad for business and destroys wealth. You know, the staff, your customers, your suppliers have all sort of moved on, and then you change the rules of the game. It impacts on trust, and it sort of really has a detrimental impact on your business, and you need to get back up to speed to run the business. You know, in one of the cases with the lawyer here in Brisbane, that company that pulled out, and we're talking, you know, multi-million-dollar sale, that business ended up in liquidation within 12 months because they'd just gone too far along the process. So it's critical to know and get some of your mindset right around what you're going to do next. So if you look at your business, you know, the common line in this slide is profitable, well-run businesses. You know, buyers will buy them. It helps with family succession, and you get a legacy. So really, most of you will say you've got profitable, well-run businesses. And the question is, well, how do you tune them up so they're more profitable and their buyers can actually, you can actually demonstrate to the buyers that the business is well run. This is an interesting slide, but it's fundamental in valuing your business. The value of your business is not determined by the amount of money you need to retire. This sounds pretty straightforward, but it's an easy thought process for business owners to fall into, no matter whether you're successful or not. And in some cases, it's really the business as you've got it makes good money, but no one's really going to pay you a lot for it. So you want more money. So what really is, how is value determined? Well, we look at 10 key value drivers, and they start out as sustainable and stable and all predictable cash flows. Well, cash is king, and if we know what cash is coming in, we know as a buyer that they're going to be pay their liabilities when they fall due, and as the owner, they'll get their wage or their return on their business. Excellent profit margins. Well, if you're buying a business, you really look at the one that's got the best profit margin. If two similar businesses for a similar price and one has a better profit margin, the question is which one would you buy? So it is around improving your profit margin, which has, well, if you look at profit in an accounting sense, it's around two things. It's around revenue and it's around expenses. So managing both of those become critical. Next is stable management team and quality workforce. You know, are the staff turning up to work? Are they keen to be there? What sort of staff turnover exists? Does the management team understand what they're doing? And will they stay and run the business and help run the business for the new buyer? These are critical things people want to do. I know a number of buyers of business, if they see there's a huge and irregular staff turnover, they rate that as a problem within the business and they don't want to buy problems, so they move on and look for another business. Define systems and processes. Yeah, that sort of stands out fairly obviously, but over time it's something that in many small businesses that aren't developed. And having this documented so people can see what's there, and then testing where your staff and your management are actually following those processes are some of the things that actually drive up your ability to improve revenue and manage your expenses. So customers and clients and suppliers. You know, you want repeat customers. You want them coming back and recurring and coming back into your business to buy the product more than once. And you want a diverse range of customers and suppliers. If you have a single major customer, yeah, that's a risk for a business if something, if they fall over or they find someone else to provide the product, your business gets unduly impacted by that sort of thing. And it's the same with suppliers. If a supplier falls over, is acquired by someone else that doesn't provide those products anymore, you know, your ability to continue to deliver what your customers and clients need is impacted significantly. So that's a big risk for prospective buyers that they're having a look at. The facilities and equipment, buyers, you know, don't want to go and spend significant amounts of money, millions of dollars in your business, and then walk in day one and have to buy new equipment. They want to know that the equipment that's there can produce the needs for the customers and suppliers efficiently, and they'll be able to make money on that equipment. Financial discipline, you know, the financial statements and forecasts, cash flow forecasts exist, that the financials have been prepared regularly, the tax returns are lodged, the systems are in place for these things to happen, and it happens relatively seamlessly. Yeah, for many small businesses, this is an area of pain because it's not their skill set, and it's not something that they like necessarily doing. So, you know, having a good bookkeeper that gets this up and running and a good accountant it becomes quite critical. But the other side of it is business owners are making sure that the current owners aren't taking too much cash out of the business that's actually risking its viability, because some of those risks pass on to the new owners. There needs to be some upside, a realistic, detailed growth plan. Can the business be sustainable? Will it continue? And if there's potential for the new buyer to go forward. It's part of marketing 101, really, in a case. If it's too optimistic, people see through that, and you know that doesn't help your ability to sell your business. Product diversity, you know, the fundamental issue here is pretty much similar to customers and suppliers. You know, if you sell one product and that product becomes unfashionable or no longer required, you no longer have a business. So there are certain times of years maybe that different products are sold or in demand, and that allows your cash flow to be managed. And the final one is reliance on the owners or the partners to generate revenue. Now, this is really probably a critical thing for many small businesses. You know, as the owner, you know, you end up controlling everything. You understand what happens in the business. You have the relationships with customers and suppliers. But the problem with that for a buyer is that, you know, if you leave, all that knowledge and those relationships disappear and have to be rebuilt. And if they've disappeared and I have to rebuild them as a buyer, why would I want to pay you for those? And one of probably the biggest reason for businesses being unsaleable is that they're totally reliant on the current owner. And that said, I'm not just talking small little businesses that are worth $100,000, $200,000 or $300,000. We see businesses that are in this sort of position that will sell for between $5 and $10 or $15 million. Everything goes through the owner or the partners who roll in the business. And so there has to be a process to address this. Here's just a little page you can print out to have a look at to see how you go. I'd suggest in most cases it's a good idea to get someone independent to actually rate this and compare it to your own rating, so you're not too either optimistic or pessimistic about how your business is going. You know, and if you're scoring, you know, you're marking out of 0 to 10 for the scores. And so if you're getting around 95, you've got an excellent business and you're doing really well. So you're pretty much spot on. Yeah, just well done at that space. You know, 85 to 95, you're probably ready to go to sale. There may be, if you get a very low score in one of the areas, maybe that's an area to address to get improve saleability, but also to improve your profitability and probably the multiple of your business. 70, if you're getting 70 to 85, well, you've got some work to do, but you've got an ability from this very small table to give you some idea where you need to focus. And perhaps you're also identifying, and you'll realize that you're identifying the areas in your business that you're not interested in or you don't really like doing, or perhaps the skills within your staff aren't there. And so it gives you an indicator where you may need to get some specialist help, or alternatively where you may need to commit some time. That said, really you don't want to be in a position to taking your time away from where you really add value to your business. And if you're below 70, you're probably in a point where you need a significant tune-up of your business to get it ready for sale and focused. And particularly if that last point about the business is too reliant on you as the owner, you're probably in need of some help, specialty advice. The important thing is if you have a look at these, a lot of them are financial, but there's a lot of drivers that sit around this that aren't purely financial. So in a lot of cases, you're after information that's provided by multiple people or multiple specialists. So it's not just an accountant that's going to be helping you to deliver this. It needs some specialty advice that are looking in a broader and a holistic view. Some pretty simple issues and tips to have a think about when you're looking about what you're selling and getting the most value for you as the current owner. So what are you selling? And initially I'm saying the business or the company. So in a lot of cases, people are looking at buying the assets and what's generating money, and they're not interested in the corporate entity that you're running the business through. In part, that's because they don't want to. If you buy a company and they buy the shares in the company, the liabilities in that company come with it, and that they last for 7 years. So there are some issues around that for buyers and risks that they may not want to have. But it also then goes to have a look at what is the business you're selling, because over time, businesses can actually end up having 2 or 3 businesses in what they're doing, and different buyers will want to buy each of those businesses. So you may have to separate the businesses to target to sell them. In other cases, we find that over time, accountants in doing the right thing to manage tax and manage risks have created lots of different entities that are doing set parts of projects or different parts of the business, and it becomes very complex both for a broker to sell your business, but for anyone who's buying the business. And complexity makes it very difficult to sell your business. So those fundamental things need to be clarified. And finally, in my experience doing due diligence of businesses, funding projects, what scared me is around 25% of the business owners we dealt with, particularly in the small space, didn't understand that last element where they've got lots of different entities running the business, because they perceive that as all being them or all being their family. And that confuses prospective buyers and raises a red flag of risk. So you really need to get that sorted out in your own mind before you start. Tax and the processes of sale. I'm not a tax expert, but the critical piece of information I'm really bringing out here is if you structure right, you can save a significant amount of tax. There's some very good tax concessions for small and medium business owners, and there's some good advantages around using super and investment post-sale. However, just recently there's been a tax case, and that's this year, where a business that was for sale did a major reorganisation just prior to sale, and the tax office reviewed it, and they said, well, the only purpose of that review and change of the business structure realignment was to mitigate tax, and therefore it's effectively a tax evasion scheme or a scheme to evade tax, and therefore we're going to see right through that, and we'll tax you with your previous tax structure. And so that seller eventually almost doubled their tax bill, and effectively it was very damaging to the amount of money that the seller came out with. So if you're looking at restructuring your business, one, for the sale process and get it ready, and to ensure that the cash that you get from the sale of the business can come to you in the most tax-effective way, you really need to be looking at that on a holistic basis, but you need to be looking at that much earlier than people previously have. As an accountant, you know, it's horrible to have a business owner come in without talking to you and bring in a contract and say, we've just sold your business, our business, and you look at them and you think, well, you know, that just cost you 20% extra in tax, and you just feel hopeless because you really can't do a lot to help in that situation. So have a look at that up front. We've talked at the next point, you know, we've talked about the value of the company. You really need to have a look at those items to what's driving value of your company. But you need to understand what prospective buyers are willing, and different types of buyers may be willing to pay for your business, and how you target what they want to get the best value. Knowing when to sell is pretty critical. You know, we've seen global financial crisis where businesses were worth millions of dollars before the crisis, and they're now worth, you know, 500,000 or 600,000. So there's the economic side of it, but also for many businesses, as a buyer, it's much easier and attractive to buy a business that's growing than one whose earnings are pretty flat. So if you've done all this work to get your business moving and tuned it all up, and it's beginning to show growth, that's probably a good time to be selling the business rather than holding on for 2 or 3 years till you fall back into some of your old habits, or alternatively the economy slows. So you really need to think about when's the best time to sell your business, and if that's the case, you've got a date, you need to work back from them the amount of work you've got to do to get it prepared for sale and start early. And the bottom line is buyers are going to need a lot of information, and you need to begin pulling that information together in one place and collating it and maintaining it. Initially that will take some time, but once you've got that in place, you're ready to sell, and if opportunities come up, for example, the person with the checkbook, you know, you're in the best position to sell. It also addresses any areas where, you know, there are issues in your business or skeletons that are in the closet that you need to be able to manage. And I'm sure Peter can talk about some of the issues around, you know, the information you provide and the quality information you provide to sellers, you know, can't be misleading. So it's important to be building that information together. Buyers will want you to be able to answer their questions relatively quickly. Okay, so that's me there, but my take-home really message is, you know, have a look at that little YouTube video, and that may be a catalyst to get you started and to do something. You know, just get started. And inevitably, for some people that aren't really looking at selling, it is actually talking to your better half or your business partners and getting the conversation moving, talking to your kids, finding out whether they're actually interested in the business, and then talking to some advisors, or especially advisors like myself, and to pull together a team to move you forward, to allow you to get those conversations converted into action and a plan that you can implement. And if you're, you know, I notice there's a few lawyers and there, you know, it is a point when you're talking to your clients to ask these questions and see where they're at, and then think about getting a specialist advisor to come in and give them some information so they can get started. Yeah, a lot of the conversations are complex, they take time, but they're critical to get moving. And with a comprehensive structured process for planning and implementing, you know, you will get a lot more value and wealth out of your selling your business, and any legacy that you're going to have has much better chance of existing. So my details are there. I'm Barry Hopkins. I work with Exit Alliance. So if you need any information, please call or email me. Happy to come and talk to you. You know, 3 hours consultation. So thanks, and back over to you, Peter.
Thanks very much, Barry. Terrific. That's really useful stuff. I'll take back over here, and with what you had in mind, how about we just ask, what do you think we ask the attendees, do they think their business is in the right shape now to sell?
Yeah, that's a good point. Excellent, that's great.
So let's have your votes in, please. Who thinks it's absolutely tip-top, ready to go? Okay. All right, we're getting some responses. Thank you. Okay, we'll leave that poll open for a few seconds because it's very important, isn't it, Barry, that all these things are done at an early stage, and there's no point putting the business on the market when there's so much work to be done and you should be starting now.
Yeah.
Okay, here we go. There's our responses. Now, most attendees are saying that there's a lot to be done first. Well, thanks for that insight, Barry.
Great.
Now, just one more thing following out of what you had to say, Barry. It might be interesting to know from our attendees who they think their likely buyer will be, whether it's an existing business or a large competitor. You mentioned overseas competitors or new entrants to the market, for example. So if you could please give us your responses on that. It gives us some insight into our audience, and also other attendees can get a feel of what others in the group are considering their sales too. All right, we'll leave that open for a few more seconds. Okay, so everyone believes they will be, their likely buyer is a larger competitor. Well, that puts you in good stead if that's the case. So that being said, I'll now move on to my part of the presentation, and I will keep it brief. I will have this, we'll finish this in about 10 minutes. So, okay, so things you need to know from a legal side are contracts and documents, representations and disclosure. I'm going to talk a bit about instalment sales, earnouts, and a few traps and tricks. Look, firstly, of course, the obligatory waiver. Please contact your lawyer. If you need legal advice, your circumstances will differ from everyone else's and everyone who I am encompassing in a very general way in this presentation. The documentation needs to address a number of things. What are you including in the sale? Barry talked about this. Give that some thought. Everything can be different. It's not necessary, for example, to include the intellectual property or even work in progress. How debt's to be managed, that's important to think about. How the price is to be payable, whether you're prepared to offer vendor finance. What's going to happen with the lease? Is your lease in order? Do you have enough years yet to run to make it viable for the buyer? How are you going to deal with debtors and creditors? Will you be responsible for the creditors after the settlement date? How are you going to deal with staff? That's always a very important one. Often buyers have requirements about key staff, and it's important to a buyer that key staff are kept on. Are you prepared to give on-site tuition? Are you prepared to stay after settlement for on-site instruction? What about a restraint? Do you need to carry on business in the same field after settlement, or are you prepared to sign an agreement that you won't do that? What about you being kept on in the business if you're a key employee yourself? Are you prepared to commit to a term of 12 months or 2 years as an employee? What about special conditions? Are you prepared to increase the value of the business by agreeing to do other things? For example, construct further sheds on the property on which the workshop business, metal foundry, for example, is conducted. And the other thing that your lawyers need to know, you haven't given good consideration, about all of the bits and pieces, the inventories, the lists. So, as Barry said, you need to give your paperwork plenty of attention well before time. Representations, disclosure and due diligence. Due diligence is really just a term that deals with doing everything possible to find out all the facts that need to be either understood in the case of a buyer or disclosed in the case of a seller. It really amounts to investigating the viability of the business and determining the veracity of the statements that have been made or the accounts which have been delivered by the seller to the buyer to examine. It also extends to assets, profitability, encumbrances. Everything about the business is usually covered in a proper due diligence process. It should be undertaken by the seller well in advance so that the information can be provided neatly and in a timely way to the buyer so they can confirm their investigations and agree or disagree with some of the assumptions made. It's important to also remember that anything you disclose can be relied upon by the buyer. Anything that you state may be able to be relied upon by the buyer. So if you say to the buyer, look, this business will give you a guarantee a profit of $300,000 every year, the buyer could rely on that representation. But statements of a lesser standard than a guarantee like that can also get sellers into trouble. So it's important to consider carefully exactly what statements are made and to ensure that your lawyer documents the transaction properly to ensure that you cannot have an accusation levelled at a later time of perhaps misleading and deceptive conduct arising out of some of the statements you may have made in person or in writing. A no representations clause is usually included in most documents, but it doesn't. A no representations clause doesn't insulate a seller from an accusation of misleading and deceptive conduct if the buyer can prove they relied upon that sort of conduct. I'm just going to talk quickly now about instalment payments. If you're a seller with a business, a buyer might want additional time to pay. For example, $2.5 million on a settlement with $2 million now and $500,000 in 12 months' time. That gives the buyer the opportunity to spread the payments, reduce the payment obligation, but it also provides a security question for the seller. How can they be sure that extra instalment will be paid in 12 months' time? Well, usually if you're dealing with a large company, that risk is smaller, a public company, for example, but dealing with a large company in those circumstances also gives it the opportunity to curtail the payment of the second instalment if, for example, the seller has been playing funny business in terms of its obligations not to compete in the restraint area. So that's an avenue for the seller, for the buyer to exercise some control over the extra payment as well, to ensure that the seller plays ball as required in those types of situations. Or, for example, if there was an undisclosed issue that the buyer only discovers after settlement, they can withhold those funds and make the seller go to court to get them, and so those issues can be determined in the forum of a court. The other situation where the other variation of a sale price where part of it's paid at a later time is what's known as an earnout. Now, this allows the seller to get the price that they think the business is worth, but only part of the purchase price is paid on the settlement date, and the remainder paid in 1 year or 2 years' time, depending on the sales that proceed after settlement. So it allows the seller to feel good about the price they will get. It puts the onus on the seller to come up with the sales after settlement. It probably only works if the seller remains in the business, so that they can, on an employment contract, so that they do have some control over what's going on. It's important to remember, though, that it's important to document how the clawback is calculated. Will it be, for example, $1 for $1? If the sales don't reach the stated value for year one post-settlement, if they don't reach the $500,000 a year, will the price come back by $1 for every dollar deficiency? So that's an important question. It's also important to limit the clawback to the extent of the retention. You wouldn't want a $400,000 clawback, retention, that the seller would only get if sales were met, but the ability of the buyer to get relief exceeded that $400,000 amount. That has happened. We've seen that in a recent transaction on the sale of a Sunshine Coast accountancy business, where the clawback, where the seller's liability ended up at close to $1 million, even though the retention was only $400,000. So just be alert to those possibilities. Be alert to the possibilities of an instalment sale or an earnout. They do create flexibility. They are a good tool that can be used in these sorts of transactions, but there are things that you need to be careful of. So buyers might have some unusual requirements because of finance. I'll just talk quickly about this. It might be that the buyer can't raise the purchase price, and exotic vehicles have to be incorporated, have to be established. For example, a new company owned partly by the buyer and the seller. That's something that can be explored as a workaround in relation to financing large transactions. Just a few more things you need to be aware of before I wind up, and that is the seller employment agreement requires particular attention. Don't forget that. Don't leave that to the last minute. We've seen in circumstances where it has been left to the last minute, litigation has followed. It's been assumed that because no formal employment agreement has been entered into, there is no obligation on the part of the seller to, part of the buyer, to employ the seller or pay him the agreed salary, even if it was only agreed orally. So those sort of complications can lead to litigation, which is expensive. Get those, attend to all the requirements before settlement. Don't leave anything up in the air on the basis of, it was agreed orally. Key staff, ensure that they're accommodated. Ensure that restrained conduct for the purpose of the seller is observed. If you're not allowed to approach former customers, don't do it. That will lead to litigation, or lead to the seller retaining some of the settlement sum. Some interesting innovations that can be included are an agreed disputation threshold, which can reduce disputes. For example, I've seen a contract recently where there's a $10,000 agreed disputation threshold. The parties could not argue with each other about any deficiency or whatever unless the value of that exceeded $10,000. And for earnouts, you can include interruption events, so that, for example, if there's a recession, 2 consecutive quarters of negative growth, the seller will not be penalised as a result of any earnout earnings deficiency. So look, I know I've gone through all that quickly, but this webinar will be posted on Carter Capital Law website. We saw the picture of Joe Hockey in the beginning, but that makes us all concentrate on taxation and business. But what I guess we're all looking for as we exit our businesses is what is going to happen, what life holds for us after exiting. And there we are, something to contemplate. With that in mind, can we just get a couple of quick questions answered before we go by all attendees? We asked before what issues you thought is important. Barry and I are just interested to see what issues you now think are important, having heard this presentation. Okay, we'll leave that open for a few minutes. Getting your business into shape, tax treatment, options following sale, for example, buying the new boat, or competent marketing of the business. Okay, a few more seconds on that. Okay, so everyone is now really focused on getting their business into shape. Finally, if you'd like us to call to provide further information, can you please indicate in this poll? Okay. Not right now. Excellent. Okay, okay, thank you for that. There we are. We've got people interested in the subject, but obviously not motivated to sell right away. Thank you for your attendance today. As I said, the webinar recording will be posted on the Carter Capner Law website. You can just Google Carter Capner Law webinar and the webinar page will show up. Thank you for your attendance. Our next webinar will be in June and the date will be posted on our website. Thank you, everyone. Thank you, Barry.